Good afternoon, everyone, and welcome to our webcast today. My name is Heidi Diner, and I'm with Citizens Bank, and I'm the National Executive Director for the Private Equity CFO Association, which, for obvious reasons, we like to call PECFOA. Anyway, I'm super excited about today's program, not just because I know I'm giving you an excuse to take a break from working on your taxes, but because I know that ESG has and continues to be top of mind for our CFOs. I am always grateful to our advisors, and today I'd like to thank Rob Robideau and Alex Bernhardt and the Marsh team for putting together today's program. Rob actually sits on our Houston PECFO Advisory Board and is a managing director with the Marsh Houston office. Before Rob introduces our speaker, Alex, just a few quick housekeeping details. We will have a Q&A, of course, at the end of the program, but if you want to ask a question throughout the program, there is a Q&A chat feature at the bottom. And you could put a question in there. We will have a few polling questions in between sections, but if you have a specific question you want to ask, put it in the chat room in the Q&A, and hopefully Rob will see it and make sure that Alex gets it. And also, we will be taping today's program. So if you want to watch it again, or if you want to share it with someone from your finance team, it will be on the PECFOA website. Just give us like a day or two to get it up there, but you will be able to access it. Speaking of our website, we do have 2 more webcasts coming out next week, both on tax, both with CPE. So if you want more information on those, again, go to the PECFOA website. I think I covered everything for me. So I guess with no further ado, thanks again for joining us, and I'll turn it over to Rob now. Thanks.
Great, thanks, Heidi. And thanks to the overall PECFOA organization. As many of you know, Marsh sits on the advisory board of many of the chapters. And Marsh's private equity and M&A services group, many of you are aware of. And so when we sat down with Heidi a few months ago, and we're just discussing kind of what are the topics that are emerging from the constituents and the membership of PECFOA, the topic of ESG came forth. And that was something that I thought Marsh would have an interesting perspective of. So you may know of Marsh's private equity team and Marsh as the insurance and risk firm, but we also are part of Marsh and McLennan and Companies, which has some sister companies. One is Mercer and the other is Oliver Wyman. Mercer's has within it an investment consulting division that works with large institutional investors, particularly around GP selection and screening, which for, I think, well over 10 years, they've had an ESG and a climate change component to that. So they've got a lot of data and a lot of intelligence around the overall space and lexicon of climate change and how that relates to general partners. So that would be a top-down view that we I think bring a pretty unique perspective to. And then from a bottom-up view, Oliver Wyman is our management consulting arm, which has a very vast global climate change desk that works with portfolio companies and large corporates to help them understand climate change and figure out how to address the commercial and sustainability elements of climate change and pivot in those ways. So pulling all of that together, we thought, wow, that's an interesting perspective that kind of is unique to you all in the private equity space, managing investments as well as managing your investor base. And so that led us to this. And so today with us is one of my colleagues, Alex Bernhardt, who sits within the MMC organization and has, I think, a very unique role in being able to look down across all of our various operating companies and pull together that information. It's a broad topic. We've got some questions that we're going to ask throughout the process, and certainly we've got some questions already from the invites, and we're going to use those questions to narrow down our focus. But by all means, if there's something in particular you want to know, please let us know through the Q&A function. I'm trying to think if there's anything else in my notes. I think that's about it. So without further ado, why don't we just get right into it, Alex?
Awesome. Thanks, Rob. Very happy to be here. Just a quick moment of additional background on myself. I was the head of responsible investment for Mercer in North America from 2015 to last year, and I'm now in working across Marsh McLennan companies on a variety of different topics, but most related to ESG, climate change, and sustainability, and trying to figure out how we can best address those complex issues for our partners and for our clients. You know, the topic of ESG is broad and expanding, suffice to say, and it has a manifold impact on businesses of all shapes and sizes. And private equity firms as investors and owners of businesses and real assets in other cases are in a unique position in the marketplace, having to address inquiries from all sides, bottom up and top down. And so we thought it would be best to take this time to do a survey, as it were, of the various different stakeholder views that might be of interest to the audience. And so what we'll do is start with a poll here, actually, first, before we jump into the agenda, because we want to get a baseline sense of where you all are coming from. So if you could just take a quick moment, please, and fill out this poll. I think we'll leave it up here for about 20-30 seconds. We can then continue on. Great. So roughly how often are you asked about sustainable investment during due diligence? And we have a very broad split, interestingly. I thought it would have been higher to the 100% range at this point, but good to see that there's still quite a few not getting those requests as well. It's good information. So what we're going to talk about here today is just a broad overview of what sustainable investment is and where it's going. Then we'll talk about what asset owners are starting to look for from their asset manager partners, both from an asset allocation and a manager selection perspective. We're then going to talk about some portfolio level general partner conditions or perspectives, the types of analytics or approaches to ESG evaluation you might apply at the portfolio level, and then we'll look at individual bottom up issues relative to portfolio companies specifically. As a starting point, we think it's important to recognize that responsible investment is not one thing. It is many, and it exists on this broad spectrum here that we've described. Socially responsible investing is based largely in the divestment movements of years past around focus on apartheid or tobacco and now fossil fuels. The broad majority of sort of SRI investors have been historically motivated by moral or values-oriented concerns. This is certainly evolving now, where SRI investors are now looking to incorporate ESG factors in a more holistic sense, and investors more broadly, especially those that have signed up to the UN Principles of Responsible Investment, which now represents close to 100 trillion, or maybe now over $100 trillion in assets globally, are committed to looking at ESG factors from a value generative standpoint. Looking to opportunistically capture as much of the information as is possible, as is out there and evolving related to ESG, and apply those ESG type data points in the investment process. And that ESG data can be used to inform negative screening, but usually not as a means of values alignment, but as a means of risk management. It can be used to apply various integration, so incorporating ESG factors into the investment process in some form or another, all the way through to potentially modifying your valuation tools so that they actually incorporate ESG considerations either in the discount rate or in the cash flows or whatever the case may be. Looking at themes, investment themes, and how they're evolving from an ESG dimension. Certainly there are a lot of them in energy, most notably, but in other sectors as well. And then stewardship, using stewardship as a means of engaging with companies to get them to improve their ESG characteristics, again, largely with a risk management orientation, but also with an alpha orientation there as well. And then increasingly what we're seeing is aspects of the market are moving in the direction of impact investing, which, these impact investors are acknowledging that all of their investments have impact, whether it's positive or negative, though, is sort of up to them. And increasingly, there's a growing recognition that it's possible to both have a positive social and environmental impact while also achieving market rate returns. And in many cases, the impact investing movement is focusing in on or starting in the private equity or private markets more broadly, but mostly private equity marketplace. And so we can talk more about that later on. But often these investments are focused on specific themes, so industry trends like the energy transition that might drive alpha opportunities or growth opportunities that are outsized over time. And the direction of travel is very much from left to right here. And so with that broad basis, another important trend to understand is this move that we're seeing away from shareholder maximization at all costs to more of a pluralistic, stakeholder-oriented view of business management. And what this perspective simply recognizes is that our businesses that we operate in all have an effect on a broader range of stakeholders, not just shareholders, and that those stakeholders, if they are negatively or positively impacted, can actually have an impact on shareholder wealth. The challenge in marrying the shareholder perspective with the stakeholder perspective is time horizon related and ESG related. And our view is that if you broaden your time horizon and you focus on ESG measurements and risk assessment techniques, that you can achieve both the best outcome for stakeholders and the best outcome for shareholders over the long term. And we call this enlightened or instrumental stakeholder theory. It's a means of really marrying these what seem to be contradictory perspectives on business management into one cohesive framework, which shows that indeed you can drive value through a broader stakeholder perspective. And underpinning this view is a whole panoply of research across various different fields, interdisciplinary areas that point to the potential for ESG integration approaches or stakeholder theory-oriented approaches to business management to drive alpha or drive positive outcomes. And on the investment side, maybe you are all familiar with this, but there's a meta-analysis done several years ago by the PRI and University of Hamburg and others that showed that over 90% of the primary studies on the connection between ESG and company performance showed that there was a non-negative correlation, meaning only a very small portion, 10%, said that ESG was actually value depletive. Almost all of the studies were either neutral or positive in connection. And that's even understanding that the databases for ESG data are messy and not perfect. And so there's definitely a lot of opportunity for alpha generation in the ESG data. Especially if you can spend time sifting through the noise for adequate signals. And then the list of research here goes on. I'm not going to cover all of these here now, and you can use these as a reference point later on. But suffice it to say that people of all types continually to care about this: regulators, customers, employees. The list goes on. So we'll pause there for a second and probably put up the second poll question, mostly so I can get a break from hearing my own voice. Okay, the question here is around fundraising strategy. Have you altered your fundraising strategy as a result of investor ESG criteria? Can you just take 30 seconds, please, and answer that if you don't mind.
So, Alex, while we're waiting for everyone to respond to that, one of the questions that came in through the email system was, can you talk maybe a little bit about the upside and downside of signing on to the UN PRI regime?
Sure.
Like you mentioned, the non-negative correlation, but maybe in some other elements as well.
Well, I think that there's, I can't say this definitively, but it strikes me that it's now the majority of investors that have signed up to the PRI, certainly from an asset base standpoint, given that we're looking at, $100 trillion asset base signed up. And so it's a mainstream thing to have signed up to the PRI and to have committed at the C-suite level to have integrated to be integrating ESG factors into your investment processes. The cost of doing it is pretty nominal. It's a few €1,000, I think, annual fee. There's a compliance burden, but again, not significant. You have to fill out your annual PRI report and disclose what you're doing in order to maintain your membership. And then you do have to demonstrate some progress against the PRI's goals over time, or otherwise risk being booted off the platform, which would not be a good look. But I don't see those as particularly deleterious or onerous in any way. It should be an easy bar to jump over. And so, I mean, I'm not paid by the PRI at all, but disclaimer. But I see no real downside in joining, unless of course you are fully tapped out and can't meet that compliance burden, in which case you shouldn't, or don't feel convicted enough in progressing on ESG, then don't do that, because that's too much of a risk. So here are the answers that we got here. Have you altered your fundraising strategy? About 56% of people have said some, which is in keeping, I think, with maybe my ongoing expectations. What do you think, Rob? That sound about right? Yeah.
Yeah, that's correct.
Yeah.
It seems about right.
Cool. So we'll start here with a view of the asset owner perspectives as it relates to general partner considerations. And one thing I should note is that ESG is influencing all sorts of different things at the asset owner level. At Mercer, we've advised trillions of dollars of asset owners now on climate change risk using our scenario modeling tools that we've built over the years. Most recently, we updated it in 2019. And what we're able to provide with that analysis to our clients is a holistic view of how their portfolio might change based on certain allocations in a 2-degree, a 3-degree, or a 4-degree climate change scenario, and that's degrees Celsius above pre-industrial average by 2100. This is the shorthand we use. What you can see here on the right is just a sample output from our our latest report, which shows that there are indeed differential impacts across asset classes across these scenarios, and that you can actually mitigate some of your climate risk by allocating on the bottom portion to sustainable asset classes. It's hard to see here, but the orange bar is private equity, and you can see that there's a negative impact expected on that asset class, generally speaking, from climate. And so there's an opportunity here through increasing the ESG awareness of a fund and focusing on sustainability themed assets to mitigate some of that transition risk and potentially physical risk as well that we see coming through this scenario analysis. But this is becoming important to the way that asset owners consider allocating to certain asset classes. And again, given that private equity is where a lot of the impact investing opportunities we're seeing in the market are arising, that's definitely an opportunity for the asset class to capitalize on. Mercer's also looking at quite a bit across all the strategies actually that Mercer rates from a manager research perspective. All of them get an ESG rating. Now in aggregate, about 4,500 strategies have received across asset classes an ESG rating from Mercer. And what we look for when assigning those ESG ratings is described in the top 4 categories here on this slide. We look at idea generation primarily. Are ESG factors influencing your buy and your sell decisions? Are you focusing in on certain sustainability trends and making those determinations? Do you incorporate ESG factors into your decision making? Is it purely qualitative, that decision making, or is there actually a quantitative element to it? And does that quantitative element extend from just a rating into actual financial ESG analysis of some sort? We then look at portfolio construction. Are your sector and region bets informed at all by an ESG thesis or a systemic risk trend that's tied to ESG? Are you carbon footprinting your portfolio to check that you're not out of step with the low carbon transition goals that have been stated under the Paris Agreement and the SDGs, et cetera. And then on the implementation and business management side, we focus here on proxy voting and engagement processes for equity managers. The same may apply in private equity as well, but on a private basis, are you engaging with the companies that you are partial or complete owners of and ensuring that they're improving their own ESG practices? And then business management is also important insofar as we don't want to see ESG being a hobby horse or some sort of sideline for an individual portfolio manager. We'd like to see that there's a commitment to ESG integration at the firm level. Have you signed the PRI is a criteria rather that we look for in that category. And the end result of our review of every strategy is an ESG 1, 2, 3, or 4 rating. And ESG 1 is the best rating, and it's a very small portion of the universe, as you'll see on a subsequent slide. and then 4 is basically, we don't know what ESG means, or or we're deliberately ignoring it. And another factor too that we look at from a manager research perspective, at Mercer, is diversity and culture. And increasingly, this is becoming, this has been a part of our process for quite some time. It's increasingly becoming important to a number of our clients. And what we look for, the reason why we look for this is not purely, for the sake of representation. It's because we also believe that it drives better outcomes, that teams with cognitive diversity make better and more creative decisions. And this sort of cognitive diversity can be driven by certainly representational differences of the typical sort, gender and race and age, but also other things that are maybe harder to quantify or aren't often as readily quantified, like educational background or regional background, language, etc. And so, looking across all these, this applies to all of the strategies that we research as well. And so, looking at the distribution of our ESG ratings across asset classes, you can see some interesting observations here. One that I'll point out is that across all asset classes, only about 20% of strategies get an ESG 1 or 2 rating, so 1 in 5, and so it's pretty hard we see for asset managers to get those higher ratings. There's certainly a differential across the asset classes. We see infrastructure and some natural resources strategies getting a higher rate of ESG 1 and 2 strategies, in part because ESG factors have a really clear and direct impact on the returns in those asset classes. Environmental mismanagement of an infrastructure project can lead to its closure or shutdown in some significant ways, for instance. So it's a key part of the process. If you look at private equity, we see that the average there is slightly above the all asset classes average, and there's a much higher proportion of ESG 1 strategies in there than most other asset classes. And that, I think, speaks to the evolution of impact investing in that asset class. There's an increasing number of private equity firms that are launching impact focused funds, and many of those are receiving ESG 1 ratings from Mercer. So any questions, Rob, that I should jump in and answer now, or should we move to the next polling question?
I think the bulk of the questions are really focused more on the asset portfolio perspective side. But one question that popped up is, where does the family office fit in that last page? I would make the first statement that by the nature of the family office, they're not typically going to be the type of GPs that are going to be assessed by Mercer, but I think you could see them kind of fit generally within the direct investment side of those categories, whether real estate or natural resources or private equity.
Yeah, that's right. I mean, to my knowledge, we don't rate many family offices unless they have stood up an asset manager that's looking to collect third-party assets. But relative to the, family offices are a client segment that we did serve at Mercer. And I think relative to other client segments like endowments and foundations and insurers and pensions, family offices, it's a very mixed bag, right? It's very much dependent on that family's views and beliefs. But we have seen several family offices that are very progressive on ESG issues and that want to go, in some cases, 100% impact with their portfolio, which means in some cases more than just we want to tilt everything towards ESG. It's we want to actually invest only in impact themed or impact focused funds across asset classes, and so we definitely do see innovation in that client segment. Let's go to the next poll while we're maybe talking some more questions, Diana.
So one other question, which kind of tracks into the portfolio perspective as well, is how much of an emphasis is being put on the implementation side of ESG. So the example is several of the private equity clients are actually engaging third-party advisors to provide an ESG score to their investments and spending that capital during the pursuit. So it's a deal cost and a real cost across their portfolio. is that something that ultimately is going to check somebody from that ESG 3 category further into ESG 2 or 1? Is there a demonstrable advantage to doing that?
Absolutely, there is. If you're trying to get an ESG rating, if that's your sort of end goal, I mean that probably shouldn't be the end goal of your process, but having a clear understanding of how your assets that you're buying are going to fare under certain future scenarios in which the climate may be different or social circumstances may be dramatically different is an important risk evaluation that increasingly has risk and return effects on portfolio outcomes. And the more that the manager can demonstrate that they're thoughtful about what's happening in the world and how that might affect their portfolio companies, how the trends in and I'll stick to energy. And this is just the most top of mind example, but there are others certainly. What's happening with oil supply and demand dynamics? What's happening with gas and methane leakage and the political trends towards carbon emission pricing potentially in certain jurisdictions, like what that could do to overall market dynamics, and being aware of that and demonstrating an awareness that you're doing some analytical work to try and understand those risks is super important. And if it requires outsourcing or incurring costs to do that, then so be it. So looking at the answer to this question is about the level of analysis being performed on climate and social risks. About a third here of no action having been taken, some, and then portfolio-wide analysis, which is really interesting. Yeah, we're seeing a even split there across those three. I think that speaks to the growing variety of different approaches in the marketplace. So looking now at the portfolio perspective, one thing that we've seen increasing demand for is a better understanding. Particularly this comes from, I'd say, more from real assets private equity funds than it does from other private equity funds, but it's relevant in both cases. Is a demand for understanding the potential physical risks from climate change to a given portfolio. And this is an emerging and evolving part of the marketplace with lots of vendors that I'm sure you've seen advertisements from around. And what we've done at Marsh and in collaboration with some third-party vendors is to develop a portfolio mapping capability, which allows us to understand where your portfolio assets are. And these could be, as I said, real assets in a private equity real assets portfolio, or they could be the brick and mortar locations of the companies that you own, or potentially some of the supply chain risks that might affect those companies that you own. And then we map them against both where they are geolocated and against future climate scenarios and what that might mean to the delta in, say, flood risk in this case. And we can, with a pretty high degree of granularity, depending on the tools used, we can demonstrate how the risk profile is going to change and where flooding would be more likely to occur in future. And then we can go even one step further from that and use our knowledge about damageability and vulnerability of properties to flood risk to quantify a damage ratio and turn that into a financial outcome that matters to your financial evaluation. And that then allows this analysis not to just be a qualitative one that sits alongside your financial analysis and can inform it, but one that actually can be integrated into your financial analysis and help you to change your valuation of your portfolio in some way, or change your risk management considerations in some way. And this is most readily applied at the portfolio level. We've also worked with a number of clients on their ERM processes to broaden the lens of typical ERM processes to include ESG risks. And oftentimes this requires coordination across the ERM department with the sustainability department and with the financial department, the CFO's department, in order to make sure that not only are we capturing the ESG risks that face the business, but that we're working to quantify, at least qualify them, but ideally to quantify them and to render them financial, so that again they can be most directly informative of other forms of decision making that take place at the company level. And we can use some of that work to develop materiality matrices and support ongoing reporting and communication, both for ERM and sustainability purposes. So it's a real opportunity here to marry those two processes that might be going in parallel right now in individual companies, either at the GP level or possibly in your portfolio companies as well.
So that's a good segue just to a quick question. So one of the questions that popped in was best practices on tracking ESG performance at the portfolio level and aggregating data for the LPs and reporting to the LPs. So I don't know if there's any other additional light you can shed on that reporting and communication topic. But,
sure.
we'll
Yeah, I would not say that we're anywhere near consensus on what constitutes, precise best practices at this point. There is some convergence around certain KPIs that are valuable for reporting purposes. One of those, and this is obvious, but one of those is carbon emissions. Having a clear grasp of what the carbon footprint of your portfolio is super valuable. Increasingly, we're being asked by clients to conduct carbon footprinting for their total portfolio, not just for their public equity assets, but to extend that analysis more broadly. And having an understanding of at least the general sector profile of your portfolio, so that we can make informed assumptions about the carbon footprint, or better yet, actually knowing what the carbon footprint is, would be super valuable as time goes on. But certainly, there's other metrics that are becoming more frequently requested and are important for alignment. But it really much depends on what the strategy is, what the intention of it is relative to sustainability, which SDGs it's potentially impacting, and then once you've identified those, picking out the metrics is a relatively straightforward process. I mean, you still have to go through some sort of materiality process to determine which metrics are most likely most material to outcomes, both social and commercial outcomes. But you definitely have a much more narrow list if you identify the SDGs again that you're impacting. So I want to shift here for a little while and talk about climate scenario analysis, and we'll start here with just a quick framing of what sort of climate scenarios there are out there and what they look like. And really they range from green to gray, 1.5 degrees all the way to 4 degrees. And in each case, the makeup of the energy sector changes pretty dramatically. We're looking at 40% fossil fuel energy use in 2050 in a 1.5 degree scenario, all the way to double that in a business as usual scenario. And the temperature more than doubles in that scenario as well. And what you'll see is in a 2 degree or 1.5 degree scenario, you see a lot of transition risk, whereas in a 4 degree scenario, you see a lot more physical risk. In both, both risks exist on both sides of the spectrum. It's just about magnitude and how significant they are, depending on which scenario takes place. And you see an inverse relationship between them, right? The physical risk will be higher in a non-transition scenario and vice versa. But increasingly, we're also noticing, unfortunately, as the science evolves, that even in a 2 degree scenario, I think our expectations of what might happen in the physical world have been underbaked till now, and no pun intended there. The physical risk is going to be more severe at 2 degrees, and I think we all realize. And so that's in part what's driving more analysis of that physical climate risk dimension going forward. And then, of course, legal risk is a big concern, something that we're looking at pretty closely in the insurance sector. Our D&O claims and other legal liability is going to increase as a result of mismanagement of either transition risk or physical risk, and that's a real open question. There's thousands of active climate-related lawsuits, very few that have actually settled or resulted in a verdict, and so there's not a whole lot of data there, but there's a very big potential risk looming out there on the legal side that we're looking into. And so one of the challenges of taking these risks into account is that they are complicated. Not only are these climate scenarios forward-looking, so we don't have actual data, we're looking at prospective projected data. It also requires some understanding of geospatial modeling and how to take some of that forward-looking analysis, and much of which is done either scientifically, so with an aim at producing scientific outcomes like carbon parts per million in the atmosphere, or economic, so which produces like GDP or GVA or interest rate outcomes. And so there are tons of tools out there in the literature that produce these kinds of outputs. You've probably heard many of the acronyms before. There's like the FUND model and the PAGE model and the DICE model and Genie and Remind, and the list goes on. And these models are all super valuable tools. They all produce slightly different results. And so having an understanding, as we've developed over at MMC over time, of what those models do and how what outputs they produce is super important to doing climate scenario analysis. And broadly speaking, we know a lot about transition risk models and physical risk models. Broadly, these are called climate economy or integrated assessment models, and they can produce really valuable outputs, which then can be used as inputs into financial models. And here's a very high-level example of how we've taken some of those inputs, and what we do is we marry them to financial statements or to expected return outcomes in the case of an asset allocation model, using informed assumptions as to the connection between, say, economic variables or physical variables and financial outcomes. We then use those modified balance sheet or expected return values to inform a scenario adjusted credit rating model or an equity valuation model or an asset allocation. And then you can compare the modified scenario model versus the baseline to get a sense of what the isolated climate impact would be. And we can apply this tool to a private equity portfolio as desired, and have done on several occasions as an example. And this will transition well into the next section, but I will pause for a moment for our next poll. And in case, Rob, you have any other questions that we might answer on the fly.
I think the next couple of questions that we've got are going to be answered through the asset perspective discussion. So we'll let that reveal itself.
Cool.
Keep the suspense out there.
Sounds good. Yeah. In the meantime, we'll ask to the panel. All done. That was fast. Before I could even read it. Have you engaged third parties to support your ESG strategy? 2/3 of people almost say no, and then we have a few yeses here. That's good to know. So there's a lot of in-house analysis happening, which I think is probably the case based on some of the earlier answers we saw, or it's outsourcing isn't happening, or ESG analysis isn't happening at all. But I think it's more the former. That's interesting. Thank you, everyone. So moving on, we talked about scenario analysis and how it might affect the portfolio level. I'm now going to dive in a little bit more detail and look at how we've applied climate scenario analysis at the asset level to do a scenario adjusted either discounted cash flow or bond valuation or credit rating model for a specific asset. And what we do here is essentially take the scenario variables that come out of those climate scenario models, which I was speaking about earlier. We then relate those to key drivers of financial statement outcomes. So price, like oil price, for instance, or the volume, say the volume of oil produced, unit costs, how much a barrel of oil costs, or an input to the energy process might cost. For instance, again, I'm sticking with energy, but this can be applied to many other sectors as well. CapEx, what's the CapEx expected for new refineries or new exploration projects, and then also asset value, which can be used to impair balance sheets in the event of asset stranding over time. And then those key drivers, once they are quantified again in financial terms, We then embed them into an income statement or a cash flow statement or a balance sheet, and then use those revised financial statements as a means of updating our a credit rating or discounted cash flow analysis, or whatever the case may be. And then we can also take these bottom-up analyses with enough data points. We can use some regression techniques to refer them to a portfolio level result and produce portfolio outcomes. So there are both top-down and bottom-up approaches to scenario analysis at the portfolio that we can take. And then I think it's also important at the asset level to consider sort of the human resources or HR considerations as they may influence outcomes. And we all know that, especially in non-capital intensive, more tech-oriented businesses, the most important asset that those businesses have is their people. And what we're seeing increasingly is that there's a lot more stickiness, a lot less turnover at corporations that have committed to sustainability, have a clear social and or environmental purpose, and carry that through not just in words but into actions with their employees. And there are ways that our colleagues at Mercer on the career side have developed of supporting corporations on this journey from, say, status quo to a sustainability leader, using both top-down and bottom-up methods. So top-down would be, changing the stated purpose of the organization, updating the human resources strategy relative to talent engagement and performance metrics, that sort of issue. And then from a bottom-up perspective, actually meeting with colleagues, educating them on this change in the corporate culture, and making sure that they are involved through a co-creation pathway in the development of the overall strategy. And then, in the end, it meets in the middle, and you end up marrying both the rational and the emotional elements of this sustainability transition, and creating a better enterprise as a result. And so there's a lot more that I could talk about in all of these dimensions. I'm gonna pause here, I think, because I'm at the end of my slides. Show you my wonderful disclaimer, and see if there are any other questions.
One of the questions Alex popped up is just a question around ESG tends to look, it seems like most of the discussion is around climate change, although the S equates social. Have you seen and done any modeling around the social impacts and how that can tailor back into the economics, along with most of the conversation being climate change and global temperature increases?
The answer is absolutely yes. I mean, some of it depends on, I guess, on how you describe social to an extent. But we have a business at Mercer called the Workforce Sciences Institute, and they've been around for quite some time, actually, and have been doing a lot of social quantification for years. They've pioneered the process of internal labor modeling, which is basically a mechanism by which you take statistical data on your hires and fires, and their gender and racial and age dynamics, and you conduct analysis of where workers are leaving and going, where leakages might be in your process, and that allows you to diagnose quantitatively where a policy intervention from an HR perspective, or where some sort of different approach to hiring or worker retention might support, say, a better gender balance at the C-suite level or at the senior management level. And then the Workforce Sciences Group has also taken that analysis one step further and quantified the impact of, for instance, we were talking about this in a client context today, taking the impact of, say, the built environment in an office into account in doing a real estate valuation. So built environment has been shown through studies to improve the productivity of employees by X%, let's just say 10%. And so you can incorporate that increased productivity, convert that into a financial value, and then use that as a means of informing the investment in, say, a green building rather than a standard building. Because building green, of course, may cost a little bit more upfront, but the results of that are if one of the results of that is improved productivity, is important to quantify. So that's just a couple of examples of social quantification that we are doing and can do more of.
Okay.
Certainly.
Thank you. I think that's the extent of the questions we've received. I think that pretty much wraps up the discussion. I think, as Heidi mentioned, a replay of this will be available on the PECFOA website, as well as the presentation deck. I don't know if Heidi, if you've got any closing remarks. We certainly want to thank everybody for the chance to talk about this topic, which is, we crammed a lot into 45 minutes. We can certainly, if you're curious about any particular component and you want to dig into it deeper, don't hesitate to send a note to us and we can point you in the right direction. Thank you. We appreciate it.